Welcome to the weekly intermarket analysis video update. This is a video where we look outside of the S&P 500, other than valuation, to see if we get any clues as to what's happening within the S&P 500. And I look at a number of different areas in this particular video. This is being prepared for Tuesday, September 2nd. The first area that I'll go through does apply to the S&P 500, although we look a little bit outside as well. And that has to do with valuation. You probably have heard about that lately. I've talked about it in the videos. Whenever the market keeps going up, it's expensive. It's expensive. We need to pull back. The earnings aren't keeping up with the price of the S&P 500. Well, that's true, but as I said a week ago, and I've said periodically, valuation doesn't seem to matter until it does. So we can't really use that as a timing mechanism. It's just something that we want to know about. And it's been that way for a few years now and becoming even more overvalued as we continue to go up with the S&P. And even if we decline, we're still going to be overvalued. It's going to take a really big shift for that to change. But that's the first area that I go through. And then we look at growth versus value. Really no changes in the bigger picture with these ratios that we look at, but we're seeing some subtle shifts more in the short term. We've been seeing that now for the past few weeks with the market potentially getting more defensive. Now, we should have gone down on a seasonal basis in August. We didn't. We've been down every year since 1950 in a post-election year, which this is what the year was. We ended up being up 1.91% for August. Now, the only month that looks worse than August on a seasonal basis is September. So we want to be aware of that. But if everybody is thinking that the market's going to go down like they kind of did in August and it still went up, is that going to be a contrarian type of move or is it going to be a self-fulfilling prophecy? We have to watch the charts, but in the meantime, we are seeing a little bit more of a defensive posturing going on between growth and value. And I'll go through those charts, but no changes to the overall bigger picture. And we look at inflation, we have the monthly chart to look at now. We are seeing longer term where inflation is going up, but in the shorter term, not really a problem. It's mainly with the inflation deflation ratio that we follow, but we're not seeing that confirmed in other areas. And in the short term, the market doesn't seem to be all that concerned about it. And then we look at other markets. We look at commodities markets, gold, currencies, things like that, because sometimes we might get some insight there. Then we look at the 11 sectors that make up the S&P, and as I always do, I look at the sector by itself first. How's that performing? And then we do a ratio with the S&P 500 to see how it's performing on a relative basis. We look at a bunch of different indexes outside of the S&P, and then correlations between different markets. And then some very long-term trends, mostly monthly charts we look at with the NYSE and S&P 500. And then at the very end, the positive and negative list. I'll tell you right now, there's no changes. Everything is positive, even though we're seeing a little bit more short-term maneuvering. The only thing that's negative is the US dollar index. That's the only thing on the negative side right now. So here's valuation. What we've been seeing for quite a while now is just continuing. Now, if you look at the PE ratio of 10, 15, and 20, those are the dashed lines in various colors here, and we are very overvalued. This looks historically at earnings reports that have already come out and then bases it around the current price of the S&P. I also break out the price and then relation to the red dash line since we seem to spend many years above that line. And that's also suggesting that we're overvalued. This is that same thing, but going all the way back to 1980, and you can see we spend many years at a time above the red dash line. Then Robert Shiller, with his more smooth approach using earnings over a 10-year period of time, still coming in at 38.94, been going up here, well above the median and mean of between 16 and 17. Now this looks forward, and even looking forward, we're looking expensive as well. We have the Mega Cap 8, of course, we call them the Magnificent 7 or the Illustrious 11, whatever you want to call them. Came down a little bit. Didn't have a really good week with the mega caps this week. They performed well Tuesday through Thursday, but Monday and Friday weren't really good days there. But we're still getting a very high reading. We still use that 10, 15, 20 scale, still coming in at 29.1. Then we look at the red line, that's the S&P coming in at 22.2, above the 20 level, even looking forward. And then we've been seeing some improvements lately with the mid caps and the small caps. And so their PE ratio is now starting to go up, but they're still more fairly priced. They like it when interest rates go down, and there's likely to be, according to the market, a rate cut when the Fed meets in September, with possibly some more rate cuts coming after that, with the economy still looking like it's going pretty good. We had GDP come out this past week, the second time we've seen this number, and the GDP was revised up and inflation stayed the same. That's a really good environment. Now, in the upcoming week, we're going to get the employment situation report. That's going to be very telling. And so we'll see how the market deals with all of that. But as the mid caps and small caps have been improving, they're going up a little bit, but still kind of in that fairly priced area, with the small caps at 15.6 and the mid caps at 16.2. All right, then we look at growth just all by itself. And we didn't set a new high here. Still looking really positive in the bigger picture, but we're not really breaking out to the upside, where we're seeing a little bit of a pickup here with value. Now, this is just looking at these charts independently, where we, excuse me, okay, one more time. Gotta love these take one videos. And when I'm recording this, it's early Sunday morning. The voice hasn't quite kicked into gear yet. But we've been seeing a little bit of a shift as value has been gaining more favor lately than growth. That's shorter term. So then we look at some ratios between the two. You can see we're still in the bigger picture. Growth is outperforming value, but pulling back. And we look at an inverted version of that same chart where value is underperforming, but starting on a shorter term basis to outperform. Is that getting ready for some kind of a decline in September? We can only ask an open-ended question about that right now, just something to be aware of. Then we look at other growth to value ratios in an uptrend, but pulling back when we look at some longer term growth to value ETFs. This is that same ratio, but flipped upside down, showing how value is underperforming, but bouncing back up. And then we look at some indexes, growth outperforming, pulling back, inverted version, value underperforming, but seeing a recent bounce. And then a growth to value ratio coming back down into the rainbow, but still positive longer term. That same thing, but inverted here. Value underperforming, but bouncing back up. So we're getting some confirmation here. Then we look at small cap growth to value, still in an uptrend. It's been going sideways going back to last spring. Now we're trailing off a little bit as small caps have been seeing a little bit more favor lately. Is this a concern? Not yet, but we just want to be aware of this. And also pulling back a little bit, not quite as weak now with mid-cap growth to value, and seeing some weakness with S&P growth to value. When the market's more positive and really more offensive rather than defensive, this ratio goes up. And lately it's been going down, but in the bigger picture, it's still going up. And inflation, this is the monthly chart I was referring to. Inflation versus deflation, going up there. It's a little bit of a concern, and the moving average is starting to turn up. But we're not really seeing that elsewhere. We're just seeing it mainly in this particular chart, so it's not really confirmed. And the CRB index, longer term, continues to be an uptrend, but could be somewhat inflationary, but shorter term doesn't seem to really be posing a problem. And this is where we've been going sideways with the CRB index. We are in an uptrend here, but not really breaking to the upside or breaking to the downside right now. And then the Baltic Dry Index continues to be in an uptrend, which could be somewhat inflationary, costs more to ship products in the Baltics. Then inflation expectations not really breaking out, but not breaking down either. We've been pretty much range bound. We went up, then we came back down. Now we're back up into the middle of this more recent range. We look at the ratio between inflation expectations, the previous chart, and tips, which if you get into tips, you're concerned about interest rates and inflation going up. And this ratio, for the most part, has just been going sideways. So we're not really getting any insight from this. Some other markets. We're still in a downtrend with aluminum, but it has been bouncing back up lately. We are in a downtrend with corn. Wheat is in a downtrend. And lumber is in an uptrend, but really been hit that 700 level and has really fallen ever since then. And then oil, not really doing too much in a longer term downtrend. It kind of bounces around. The energy sector had a really good week this past week, and a lot of that is being attributed to oil actually bouncing up a little bit. Then we look at the correlation between oil and the 10-year yield, slight tendency to go in opposite directions. You can see here where oil was going up, the 10-year yield was going down, so that's opposite. Then the gold to oil ratio. Now, gold is possibly breaking out. I'll show you that chart here in a moment. And oil went up, and so we're seeing this ratio going up just a little bit, but no real conviction right now. Gas in an uptrend, but really dropped down. Could be dropping after the Labor Day weekend. A lot of people driving right now. Heating oil is hanging on to a downtrend, even though it's been bouncing up a little bit lately. And then natural gas also in a downtrend here. And diesel, after it was declining, now it's starting to go back up, but not really breaking out at this time. Fertilizer, after it had been going up, now it's starting to drop back slightly. So that helps the inflation area there. And then copper, which had been really strong, took a big hit when some tariff news came out. And it's still in an uptrend here and not really recovering all that much. But we would like to see this doing better than it is. And the copper to gold ratio really came down when copper took that big hit. Then it started to bounce back up. Now we're seeing that ratio coming back down. Longer term, also plotted with the 2-year and 10-year yield here. And we've been seeing a real drop off here as interest rates have pretty much been going sideways, but we're going down ever so slightly with the 2-year yield. This is where some of the gold bugs are probably happy about this. They're considering this to be a breakout. Now, this is the ETF, not the futures contract, but we did set a new high here in Friday's session, a little bit above this previous intraday high that we saw. And silver is setting a new uptrend or all-time high in an uptrend as well. And then we've been coming down lately with this ratio. That means silver is outperforming gold. And then we compare that to the US dollar index, and we see there's a pretty high correlation between the gold to silver ratio and the dollar index. These two charts have a tendency right now, anyway, to go in the same direction. And the dollar is in a downtrend. If you watch the weekly video, we're also in a downtrend on the weekly chart as well. The euro is in an uptrend as the dollar has been going down, and the Japanese yen has been going sideways, but still in an uptrend compared to the dollar. Here's the euro, still kind of dancing around its 50-day moving average when compared to the dollar, drifting a little bit, but still in an uptrend with the Japanese yen to the dollar and coming back up to its 50-day moving average with with the British pound to the US dollar. Then some ratios, and this is actually, you could take it as positive or negative. We're seeing the red line, which is the equal weight version of the S&P, and then the bar chart, which is the S&P weighted index. We're seeing them pretty close to each other. On the positive side, that means more stocks are participating. On the negative side, that means the big stocks are underperforming, and those are the stocks that really drive the indexes higher. So there's kind of a different way of being able to take that. And we've been bouncing back up a little bit when we look at the ratio between the equal weight and the S&P. After going back to 2023 here, this has really been underperforming because the really big stocks have been outperforming. Then the stocks to commodities ratio, stocks are still outperforming, but pulling back a little bit here. This also shows how commodities are underperforming, but seeing a little bit of a recent bounce. NASDAQ 100, still doing okay when compared to the S&P 500, but pulling back recently. And the S&P 100 pulling back a little bit. Those are the biggest stocks that make up the S&P 500. And the NASDAQ doing quite well, but has some overhead resistance it needs to deal with. Still outperforming, but pulling back a little bit when compared to the S&P. This is where if we're seeing any kind of a change, and it's not necessarily negative, it could be taken as positive. The NASDAQ 100 has been underperforming the rest of the NASDAQ enough, so now we're seeing a death cross with this ratio. But we've been going up, and the market's been holding up well. But we would like to see this ratio going up. But that's the negative side because they drive the indexes. The positive side is the NASDAQ is bigger and it's outperforming. And that means there's more broad participation. Then we look at mega cap to equal weights coming back down to the 50-day moving average, but in the bigger picture, still outperforming. So we're seeing a confirmation of the short-term, more defensive posturing. The small caps are much improved, but they have a long ways to go to get back above the moving average and to eventually turn this ratio up. And here we can see the long, slow decline of the small cap to S&P ratio, the red line going down, as the blue line, which is the S&P, has been going up. And robotics and AI ETF still holding up well, not really breaking out, but not breaking down either, but still underperforming with this particular ETF when we compare it to the tech sector. And mega cap growth, it was down on Friday, but still above its 50-day moving average, still in an uptrend here on the daily chart. The Dow Jones Composite Average not really breaking out, but not breaking down either, also in an uptrend. And we would like this to do better. It declined on Friday. This is the semis to tech ratio, and not an awful lot of conviction. We've been kind of range bound lately. It seems like it shows some weakness as the market's getting more defensive. Then it starts to go back up as the market's turning more offensive. Not really going anywhere overall with this overall ratio, but we want this ratio to go up for the semis to outperform tech to be more positive on the market. Small caps also improving when compared to the tech sector, but still a ways to go to change the long-term trend. Low volatility stocks still continuing to go sideways, still in an uptrend, but when we do a ratio with the S&P, still continuing to underperform. This is bigger picture. This is longer term. And so even though we're seeing a little bit of a tick up here with this ratio and some other growth to value ratios that are shorter term, showing some weakness in the bigger picture here, this is still looking positive. Then all world, when you take out US stocks, still doing quite well here, but underperforming when we put US stocks back into the equation. Then growth stocks versus government bonds, still holding up fairly well here. And then the energy sector, which bounced up compared to tech, but in the bigger picture, it's still in a downtrend. The tech sector, the 10-year yield, tech sector is still outperforming. This is that same thing, but inverted, showing how the 10-year yield is underperforming the tech sector. And we look at discretionary to staples. And I've said this over and over. It may not even turn out to be true, but a year ago when we had that down day, when the VIX hit 65 and everybody was freaking out, and it turned out to be pop news that just lasted for a few days. Once we finally got beyond that, discretionary was the best performing sector going into the end of 2024. We're seeing an improvement here with discretionary to staples, and discretionary by itself, that I'll show you later on, is doing okay. And it's doing okay on a ratio basis as well. Are we going to see a similar thing this year to what we saw a year ago? And here's staples underperforming discretionary. That's longer term, more positive. All right, and then gold, it ticked up a little bit here, but not really seeing much of a change with the gold to S&P ratio. But we went up just a little bit where we've been range bound with the gold to dollar ratio. And then here is where we look at the advanced decline line. We're still above advancing moving averages with all the main indexes that we follow. Coming off of a recent all-time high with the Dow, not there with the transports. That's a negative confirmation. Now, we did set a recent high, and some people don't use utilities as part of traditional Dow theory, but I do. That did set a new high here back in August. Then later on, we set a new high with the Dow, but it's not confirmed by the transports, even though they have been trying to improve lately. All right. And we've been just chopping around, going sideways with the Dow to transports ratio. Still not really breaking out, not really breaking down, trying to improve overall with the transports here. But when we compare it to the S&P, we're starting to flatten out after we had been seeing a long-term decline here. And we've been seeing that now for a while. And then the correlation starting to get a little bit stronger again when we look at the S&P to Dow transports, but still up in the red area overall. A couple of ways to look at this chart. We did set a new all-time high with the S&P. And we set one a while ago, but not an all-time high here with the NASDAQ. You could take that as positive, meaning that they're now confirming each other. You could take that as negative, meaning that, okay, the NASDAQ didn't set the new all-time high when the S&P did. That can be taken as a negative divergence. If you're more positive, then you see this as positive here. If you're more of a perma bear, then you probably see this as more negative. We also see a similar type of thing here. When we look at the equal weight, which did set a recent all-time high, but that was not confirmed by the equal weight version of the QQQs. It still has a ways to go. but it did set an all-time high here at the end of July that was not confirmed by no, that was not a new all-time high here, maybe just a little bit there. So again, it depends on your own personal interpretation. The FANG index did set an all-time high on Thursday, but then gave it some back on Friday. The Wilshire set an all-time high on Thursday, declined on Friday. The same thing is true with the total US stock ETF. The NYSE composite, that's still looking good and setting all-time highs, even though it was down slightly on Friday. Still looking good here, another barometer of the economy with high leverage loans. Micro caps not back to an all-time high yet, but they are in an uptrend. All stocks kind of seem like they're losing a little bit of steam here because US stocks have been underperforming international stocks, but when taken together, they're still looking quite good. Semiconductors, the SMH ETF here, coming back down to its 50-day moving average. Not breaking down, but not really breaking out either. And we're coming back down into the top end of the rainbow with the SMH ETF. And then the AI and tech ETF, this also not breaking down, but not breaking out at this time. And then ARC kind of going sideways as well. Emerging markets looking good, but still a ways to go to get back to all-time highs. Bitcoin drifting off, falling below its 50-day moving average, but still in a longer-term uptrend. And looking pretty good with the Japanese Nikkei. Not too far off of all-time highs there. And then still looking pretty solid here with the home builders study. We have the S&P on top, the home builders ETF, and we see there's a pretty strong correlated relationship between the two. And home builders are improving with interest rates coming down, and as we've been coming up out of the April lows. Then we're trying to turn back up here with the long-term oscillator, the KST. We're looking a little more positive in China. Emerging markets are turning back more positive, where we're starting to roll over a bit in Europe. Still in an uptrend in Japan, and still in a downtrend here with the S&P. So Asia is looking a little more positive, according to this chart, where European and US markets are looking a little bit weaker. And then we look at a long-term monthly chart of US to world stocks here. Still above the advancing moving average, but not showing any real strength and flattening out. We're starting to begin a new month here with the PPO. We finished out August, and now we'll be going into September. Then we look at bonds based on price, which have been holding up quite well. We're above 50 with the RSI. We're seeing positive momentum with the MACD. Total bond ETF in an uptrend here. Now we did finish this out, the stock to bond ratio monthly chart, showing how stocks are outperforming and bonds are underperforming stocks on the daily chart. Then junk bonds here also holding up quite well. Investment grade corporate bonds also performing in an uptrend here, and really choppy with the Pring World Bond Index, but continues to be in an uptrend. And the stock to bond correlation is quite high. So if bond prices are going up, stocks are going up at the same time. If they're going down together, at least according to this correlation chart. And then the corporate bonds pulling back a little bit, going sideways lately, but they are in an uptrend. Junk bonds doing quite well, came down to their 50-day moving average and were able to bounce up off of that. And junk bonds are outperforming more conservative government bonds here. This ratio continues to go up. This is not necessarily becoming more defensive. Riskier bonds, though, when we look at junk bonds versus conservative bonds, we've been going sideways with this ratio and coming down, dropping a little bit below the rainbow here, but not really a lot of conviction currently. Still setting a higher range here with the 10-year yield, which has been developing now for the last couple of years. And this is where we've been seeing a drop off here with some of the shorter term maturities. We want to keep an eye on the 30-year. It's been holding up a little bit better, and it's closer to that 5% level there. If it really starts to break to the upside, that might be taken as more negative. And we're watching Japan, the red line here, the 10-year yield, to see if that carry trade ends up developing into something like it did a year ago. And then we look at stock to bond short term, still looking good here with that ratio. Then this is further out bonds, showing how they're underperforming longer term. That's positive for stocks. And then S&P 1500 to short term bonds still holding up there. And then we use the Schwab US Broad Market ETF. I just call it the Broad Market versus 3 to 7 year bonds, still holding up quite well there. The tech sector looking a little weaker, coming back into the rainbow when we compare it to 3 to 7 year bonds. And then stocks outperforming the 10-year yield. And then longer term, still looking more negative with the long-term price of the bond. As we're watching that because it's kind of giving us some concerns in the shorter term, but the monthly chart is still in a downtrend. And then we look at a longer term ratio between the long-term bond and commodities, and that continues to decline. Then we look at the volatility of bonds. That's the MOVE index, still coming down overall. The volatility of stocks measured by the VIX, that's still under 20 and continues to be in a downtrend, and a fairly strong correlation when we look at the volatility of stocks to bonds. Then the sectors. This is the chart all by itself. Materials are in an uptrend, but underperforming, but starting to bounce back up here when compared to the S&P. Communication looking pretty solid here, but going sideways. Now the S&P's been going up and communication's been holding up, but we're not seeing communication really outperforming. If we go back to the spring and through the summer months, we would like to see this ratio really go up to be more positive. And energy starting to generate a golden cross here, crossing above both moving averages and improving when we compare it to the S&P, but we're still in a downtrend longer term. Financials improving, also setting a new high with the sector and improving with the ratio when compared to the S&P, but still in a downtrend. We've been seeing this going back to last spring where the financials, although doing good, have been underperforming the S&P. Lately, since the beginning of August, we've been seeing this ratio improve. That would be more positive if this ratio continues to improve. Industrials kind of going sideways right now above their 50-day moving average and below the 50-day moving average with the ratio to the S&P came almost down to the 200-day moving average and is holding above that. And the tech sector, not back to all-time highs yet, but still in an uptrend and underperforming a little bit lately, but still in the bigger picture doing quite well when we compare the tech sector to the S&P and chopping along sideways with the staples, still longer term positive, but underperforming. But we see this little bit of a blip up. And now if that continues, that could mean the market's getting more defensive. Real estate, still in an uptrend, a lot of sideways action here. It likes that interest rates may be coming down and improving, but still in a pretty decisive underperformance when we look at the ratio to the S&P. Coming back down to the 50-day moving average with the utilities, but they are still in an uptrend and kind of chopping along sideways and actually starting to underperform here with the ratio to the S&P. Healthcare came back up to its 200-day moving average, can't seem to get above that, and underperforming, but bouncing back up lately when we look at the ratio to the S&P. Seeing a little bit of a breakout here with the S&P to utilities ratio, but no real conviction right now. And discretionary, again, not back to all-time highs yet, but we are in an uptrend when you look at this all by itself, and not really doing all that great though. It's improving. We're seeing this coming back up, but we would like to see this ratio really go up when compared to the S&P. Coming back down to the 50-day moving average with the SOX index, that's the semiconductors. And then the Dow Jones Semiconductor Index, still in an uptrend, but doing a lot of sideways movement lately. And kind of going sideways now with the semiconductors to Dow ratio. And then longer term, still looking pretty good here. That's a 200-week moving average on a weekly chart of the SOX index. And then the intermarket analysis chart. It's starting to break out a little bit here with gold. Still the best performing asset in 2025. And then second place would be stocks. Then we have in purple, those are commodities. Dark blue, those are bonds based on price. Back down to break even with the red line, that's oil. And then the dollar, which has really been helping stocks to go up. A weaker dollar helps, the market likes that. Okay, correlations here. When we look at the S&P to the dollar, the S&P has been going up as the dollar's been going down, and we're seeing that reflected in the correlation. They're going in opposite directions. The S&P to oil, though, both have been kind of going back up lately. We're seeing them having a stronger correlation. And then we see an opposite correlation here with the S&P to the 10-year yield. The S&P has been going up as the 10-year yield has been coming down. And then the tech sector to the 10-year yield, also slight correlation going in opposite directions. And more strong here in the shorter term with the S&P going up and the 2-year yield actually going down. And the correlation is picking that up, that they're going in opposite directions. Then some long-term monthly charts here. Still looking really good, setting highs here with the NYSE monthly chart, but we're still in a downtrend. We're trying to turn back up with the copy curve, but it hasn't crossed over positive at least yet. And then another monthly chart of the NYSE with the NYSE record high percent index. This is going up and that's positive. The S&P still looking good longer term, and we're going up with the PPO momentum oscillator there. That's positive longer term as well. Still looking good with the S&P, but we're seeing this ratio going down when we compare stocks to commodities longer term. Daily charts, stocks are outperforming. Longer term, commodities are outperforming. And then the monthly chart still hanging out around above this advancing moving average here, but the KST, a longer term oscillator, continues to decline. So, and I'm going to read these off. I didn't do this last week either. Everything is positive that's on here. There's only one thing that's negative, and that's the US dollar index, which is on the next slide. So you might want to look this over really quick. And then here's the negative part of the analysis that I do. Thank you. I hope you found this helpful. I hope you're having a very good Labor Day weekend, and I will talk to you in the next video.